All right, let's take a look at the HELOC versus reverse mortgage challenge. So here's why I think that HELOCs are generally more risky than a reverse mortgage. First and foremost, both HELOCs and the reverse mortgage line of credit are both adjustable rate mortgages. The difference is that with the HELOC, if interest rates go up, your payment towards the HELOC is also going to increase. Whereas with the reverse mortgage, if interest rates go up, your monthly payment towards the reverse mortgage doesn't increase because you don't have to make a monthly payment. You still got to pay your property taxes and homeowners insurance. The second one is that HELOCs are typically interest only for 10 years. So the issue with that is that most people will make that interest only payment, and at the end of that 10-year period, the loan will become fully amortized, and therefore their payment will increase significantly so that they can actually get that HELOC paid off. Whereas with a reverse mortgage, you could make an interest-only payment, you could make no payment at all, you could make as big or as small of a monthly mortgage payment as you want, but there is no monthly mortgage payment required with the reverse mortgage. The third one here is the more you borrow with a HELOC, the higher your monthly payments. So think of it like a credit card, right? The more you charge on the credit card, the higher your monthly payment's going to be. Whereas with the reverse mortgage, even if you pulled out all of the money out of the line of credit and the reverse mortgage, your monthly mortgage payment's not going to increase because, again, you don't have to make a monthly mortgage payment. Still got to pay your property taxes and your homeowners insurance. The fourth thing here is that HELOCs have a limited draw period. So HELOCs, typically, you can only draw for the first 5 years. And after that point, you can no longer draw from the HELOC. Whereas with the reverse mortgage, as long as you are following all the terms and conditions of your loan, there is no limited draw period. As long as you have funds available in that line of credit on the reverse mortgage, you can draw from them. And finally, what most people don't consider is that the HELOC could leave a spouse in a financial bind. And here's what I mean by that. If you and your spouse go to your bank or credit union to get a HELOC and you qualify and the payment is manageable with a dual income, what a lot of people don't consider is what happens if one of you were to pass away and household income is lost. At that point, the HELOC payment could become unsustainable for the remaining spouse. Now, I'm sure you're thinking, Matt, all you do is reverse mortgages, so of course you don't think any other type of loan is good. And, I love this quote, which is, when your only tool is a hammer, you tend to see every problem as a nail. And I do not see every problem as a nail. Even though I specialize in reverse mortgages, it's all I do, there have been plenty of times over my career where I've either referred people back to their bank to get their HELOC or to another loan officer to refinance their home because the reverse mortgage just didn't make sense based off of what they were trying to accomplish and their timelines and the horizon and things like that. The reverse mortgage doesn't always make sense. A lot of times it does, but not always. So let's compare a HELOC to a reverse mortgage. And I think looking at these two things side by side is really kind of eye-opening for a lot of people. Obviously, the riskiness of a HELOC was probably eye-opening for a lot of people, but looking at them, comparing them side by side is pretty awesome. So let's look at the scenario of Rick and Jenny. They're both 65 years old. They've got a good income of $5,500 a month. They own their home free and clear. They want to remodel their home and they need about $75,000 to do it. But they want to compare a HELOC to a reverse mortgage. So what they did is they went down to their local credit union and got this information from them. So they could get a HELOC for as low as 8.99% APR, and they probably would get the lowest APR because they have good credit, assets, income, etc. So they got this information and they brought it to me, and then I was able to put this together for them, which is a comparison side by side of comparing it the HELOC to the reverse mortgage. So if we look here, option 1, this represents the HELOC. And again, we're assuming that $450,000 value, 8.99 APR. They qualified for a $200,000 HELOC, even though they only need 75. I'm assuming that they are not, that the credit union didn't charge them any fees for the HELOC, and then they're going to draw that $75,000 out. So these numbers are represented by this bar chart down here on the bottom left. So the blue is the home value, and we can see that that's increasing. We assume a 4% appreciation rate. And then the orange represents the line of credit loan balance. And we can see that this loan balance is the same for the first 10 years because they're making an interest-only payment, which in this scenario is $561 a month. Now, the option 2 here represents the reverse mortgage. The credit line growth rate, which is the expected rate plus 0.5%, is 6.92%. They can only borrow $165,000, which isn't as much as the HELOC, but it's more than they need, right? Because they really only need the $75,000. Then there's $18,000 of closing costs, which they're going to lump into the loan, and then of course they're drawing out the $75,000. So these numbers are represented by the bar chart down here on the bottom right. Again, the blue represents the home value. The orange represents the loan balance over time. And we can see that we're actually paying this loan balance a little bit down over time. And that's because there's the expected rate is lower than the HELOC. But we're also borrowing more money with the reverse mortgage. Then we have the line of credit. And we can see initially we're starting off with a $72,000 line of credit. And that is the difference between their principal limit, the closing costs, and then drawing out that $75,000. So the 72 is what they have available after drawing out those initial funds. Now, the line of credit you can see is actually growing over time. And there's 2 reasons this line of credit is actually growing. First and foremost, any money that's available in that line of credit is growing at the current interest rate plus 0.5%. So in this example, 6.92%. But we're going to make the assumption that Rick and Jenny, since they were going to make a payment on the HELOC anyways, that they're going to make a monthly payment towards the reverse mortgage. And when they make a payment towards the reverse mortgage, not only do they pay their loan balance down, but it increases their line of credit. So not only does any funds available in the line of credit grow, but any payments increase that line of credit as well, which is pretty awesome. So here's the thing. Rick and Jenny, they don't really like this loan balance sticking around for as long as it is, and they don't want to have this thing sticking around for the next 20 years of their retirement. So they decide that they're going to make a payment big enough to get this thing paid off in 10 years. And so that's what this is. This next chart shows them they would make a payment. All the numbers here on both options are the same. The difference is to get this thing paid off, the HELOC paid off in 10 years, they'd have to make a payment of $949 a month. And so we can see by year 10 that it's paid off. Now, with the reverse mortgage in year 10, they still owe $22,000. They've got it pretty close to being paid off. And if they wanted to, they could continue to make payments. But in this example, I'm showing them stopping making the payments in year 10. So we can see by year 15, let me get over there real quick. By year 15, the loan balance has increased because, again, we are assuming they stopped making payments towards the reverse mortgage in year 10. But what's really, I think, exciting about this is look at this line of credit in year 10, $307,000. So by increasing that payment about $400 a month, they've increased their line of credit. So previously it was $240,000, making a payment of $561. Now it's $307,000. And in year 15, it's $434,000. So by making that payment has a big impact on that line of credit and the funds that are available in the available to the borrower. Now, again, you may be thinking, why on earth would we do this, especially when those fees are so high? Well, there's a lot of reasons. First and foremost, year 5, we know that generally a HELOC you're no longer going to be able to draw money from. 2, in 10 years, right? Remember, it's interest only for those first 10 years. But when year 10 rolls around, that payment was originally $561. It's going to be $949, assuming a 10-year amortization on that. The third thing we have to look at is again, we already talked about this, but what would happen if a spouse was lost? Would the remaining spouse be able to continue making payments that large? Would they be financially impacted by that HELOC payment? So again, the reverse mortgage just gives a lot of financial flexibility that a HELOC does not. And then, of course, being prepared for other things that may pop up during retirement, which can be financially devastating, financial shocks such as medical care, long-term care, dental needs, home repairs and maintenance. All those things could eat into a retirement savings significantly, but we're going to be set up by structuring the reverse mortgage this way and making these payments. We're setting ourselves up with, again, another source of funds to deal with those expenses when they pop up. So you want to see how this would work for you? Give me a call. Happy to run scenarios for you, do some forecasting on like what you just saw, and see if the reverse mortgage is a better fit for you than the HELOC. There's no cost to speak with me or to answer any questions that you have about reverse mortgages. I look forward to speaking with you. Thanks.